Welcome to an in-depth look at how law firms are the hidden architects of billion-dollar deals in private markets. They are more than just advisors. They are integral to every stage of a transaction. In this video, we'll explore the foundational and strategic role law firms play in shaping the private market landscape. Law firms are not merely legal advisors in private markets. They are strategic enablers, intricately involved in every facet of deal-making. From inception to exit, their expertise ensures deals are structured effectively, compliant with regulations, and protected against unforeseen legal challenges. Whether it's private equity, venture capital, or infrastructure funds, all depend on law firms for legal clarity and precise execution. As deals grow in size and cross-border complexities increase, robust legal oversight has become a significant competitive advantage. Let's dive into the foundational role of law firms in private markets, a role that goes far beyond simple legal counsel. Every private equity transaction involves a network of specialized law firms. This includes fund counsel, regulatory advisors, tax experts, and local partners, each bringing unique expertise to the table. These firms ensure smooth coordination among all stakeholders, meticulously minimizing deal friction and preventing documentation errors. Their precision is key to efficient deal execution. The legal life cycle in private markets is extensive, covering multiple critical phases: fund formation, deal structuring, due diligence, negotiation, and post-deal governance. Each phase requires specialized legal input. Legal teams are crucial for maintaining compliance with regulations, whether it's SEBI for AIFs, RBI, and FDI FEMA norms in India, or global guidelines from SEC and FCA. This ensures all transactions meet stringent legal standards. Their role is pivotal in ensuring that every legal document precisely aligns with both the commercial intent of the deal and the protection of investor interests. This delicate balance is fundamental to success. It's common for multiple law firms to be involved in a single deal, each specializing in different aspects to cover all legal bases comprehensively. Now let's look at an overview of the legal life cycle of a private market investment, step by step. The first major phase is fund formation, involving the structuring and drafting of critical legal documents for alternative investment funds, or AIFs. The foundation of any private fund starts with legal structuring, which includes determining fund domicile, investor types, and regulatory classifications. Law firms draft critical documents like the private placement memorandum and a limited partnership agreement. These documents govern essential aspects such as fund governance, management fees, carried interest, and investor rights. Firms provide crucial advice on choosing the appropriate AIF category based on investment strategy and regulatory flexibility. They also ensure stringent compliance with anti-money laundering and know-your-customer regulations. Effective structuring at this stage is vital, as it directly impacts investor confidence and the fund's long-term scalability. Next up is deal structuring, where legal frameworks are designed and the all-important term sheet is drafted. Once the fund is ready to deploy capital, law firms meticulously craft the deal architecture. They work in tandem with investors and founders to draft term sheets that precisely outline valuation, governance, and exit terms, setting the stage for successful investment. Common clauses they manage include liquidation preferences, tag and drag rights, anti-dilution protection, and various veto rights. Legal teams ensure that all commercial negotiations are accurately and robustly reflected in the legal documentation. Furthermore, they perform comprehensive regulatory vetting for cross-border investments, including tax-efficient structuring and securing FEMA approvals. This stage crucially bridges commercial negotiation with enforceable contract law, a critical balancing act in private equity and venture capital deals. Now, let's explore legal due diligence, or LDD, a crucial phase dedicated to uncovering potential risks before any capital is deployed. LDD is a fundamental step before capital deployment. Law firms meticulously analyze a target company's incorporation, ownership structure, and statutory compliance, ensuring a clear legal standing. They scrutinize change of control clauses in key contracts to prevent penalties from future acquisitions. Other critical risk areas include litigation exposure, intellectual property ownership, employment contracts, ESG compliance, and data protection policies. The due diligence report directly impacts valuation, indemnities, and deal timelines. LDD findings enable investors to quantify legal risks, transforming unknowns into measurable and negotiable factors. A core aspect of LDD involves verifying corporate structure and meticulously reviewing change of control clauses in existing contracts to understand potential implications for future transactions. Law firms also meticulously identify IPIT risks, uncover ongoing or potential litigation, and analyze employment liabilities, providing a comprehensive risk profile for the investor. Moving on, we come to the crucial stage of negotiation and documentation, where the deal truly takes its final legal form. This phase centers around the share purchase agreement, or SPA, along with critical elements like representations and warranties and indemnities, which collectively form the backbone of the deal. Once due diligence is successfully cleared, law firms spring into action, drafting and finalizing the definitive agreements. The share purchase agreement is paramount, as it precisely defines the transaction's scope, the agreed-upon purchase price, and all necessary closing conditions. Representations and warranties, commonly known as R&W, are vital as they ensure the seller's accountability for the accuracy of all disclosures made during the deal process. Concurrently, indemnity clauses are drafted to protect buyers against any financial losses that might arise from breaches of these representations. R&W insurance is increasingly being utilized to mitigate post-closing risks, particularly in complex cross-border transactions, effectively bridging gaps between buyer and seller expectations. Furthermore, for debt-backed deals or leveraged buyouts, financing documentation, including credit agreements and security documents, are meticulously prepared. Law firms act as indispensable deal coordinators, orchestrating the timely closure of transactions and ensuring all proper regulatory filings are submitted to authorities like the ROC, SEBI, or RBI as applicable. The legal journey extends far beyond the initial acquisition, encompassing meticulous post-acquisition management and strategic exit planning. The legal journey doesn't conclude with the signing of a deal. It continues throughout the ownership period and extends to the eventual exit. Law firms provide continuous advice to portfolio companies on various tasks and responsibilities. The legal journey doesn't end at the deal's signing. It continues through ownership and exit. Law firms advise these companies on compliance, governance frameworks, and shareholder relations. They are instrumental in assisting with add-on acquisitions, restructurings, or mergers to scale portfolio value effectively. During exits, whether through IPOs, trade sales, or secondary transactions, law firms meticulously draft offer documents, manage disclosure obligations, and oversee escrow and other crucial arrangements. They also provide critical advice on capital repatriation and structuring tax-efficient exit strategies. Their post-deal counsel ensures continuous investor protection and governance continuity across multiple ownership cycles, maximizing long-term value. Now, let's explore an emerging and fascinating trend: private equity firms investing directly in law firms themselves. The legal sector itself is now attracting significant private capital. In the UK, Australia, and certain US states, alternative business structures, or ABS, permit non-lawyer ownership in law firms, fundamentally reshaping their operational landscape. Private equity funds are seizing opportunities to back innovations in legal tech, document automation, and AI-driven compliance solutions. This trend is actively reshaping the traditional delivery model of legal services, fostering more scalable, data-driven, and ultimately more profitable law firms. Law firms, backed by private equity capital, gain the ability to invest heavily in cutting-edge technology and expand their operations globally, reaching new markets and clients. This intersection of capital and law is rapidly creating a new subsector: legal as an investable asset. In conclusion, let's summarize the strategic imperative of legal rigor in private markets, along with an important disclaimer. Law firms are truly the silent, yet powerful force behind private market deal-making. They meticulously ensure that every transaction rests upon a strong, unshakable legal foundation, safeguarding investors, enabling efficient execution, and guaranteeing transparency throughout the entire process. As private markets continue to mature and grow in complexity, legal precision has emerged as a critical strategic differentiator. The message is clear and unequivocal. Unwavering legal rigor is what truly drives deal integrity and builds enduring investor trust. Remember, this content is for educational purposes only and not financial advice.